Good morning. Welcome to today's weekly investor briefing. In today's briefing, we will have one of our own, that is Gerald Morioki, who will take us through the whole session. For new attendees, I'd like to highlight that you can share your questions through the chat section down on your screen or the Q&A section. Thank you, and Gerald, you can take over.
Thank you, Daniel, and good morning all. Let me share my screen. Yes, so a recap of the activity in the market last week. Basically, we are seeing a trend over the recent weeks, and this persisted over the course of last week. Market is barely moving. We are stuck at between 1 and 0 point something percent in the last couple of weeks. And also, when you look at turnover levels, they are also coming down. I think part of last week we saw quite a low turnover, year's low turnover, about 74 million. So that is something that has been trending over the recent weeks. Activity from the foreign side still controlling the market, but steadily coming down. I think the last 3 weeks we are coming from a foreign turnover about 75%. And now we are coming at, last week we came at about 69.5%. And then foreigners are still selling out of the market, a lot of profit taking, mostly on Equity Group and EABL last week. And then they are still buying Safaricom. I think this has been a trend over the recent weeks. And then they also bought into KCB and Bamburi over the last week. However, for KCB and Bamburi, this was very marginal. This was on very marginal volumes. So the top traded counters, the usual Safaricom, KCB, Equity, and EABL, basically the counters which have the strongest fundamentals, and they always attract the highest foreign activity. From where we traded compared to our African SSA peers, our market PE is still quite attractive. I think 9.3 times compared to the average African stock exchange of about 11.9. And the dividend yield is also quite good, 5.3% compared to the African average of about 4.5%. So on average, in the SSA market, we see our market is trading at very good levels, and we still encourage investors to keenly look at some of the stocks that have strong fundamentals, as we'll see in our subsequent sections. So ideas for the week. Long term, you still maintain our long-term bias towards the strong fundamental stocks. But for this week, we are keen on stocks on Equity Bank. I think it has come over last week, the price has come to very attractive levels. I think at some point I saw a price of about 34. So it breached a key point of about 35 shillings. And I think below the price of 34 shillings, it's a very good pick for long-term investors. So backing this technical point where it's trading at, I think the bank is still strong, has strong fundamentals, and then high earnings power. I think it's the bank that usually has the highest ROE across the listed banking space. So investors could look at that price level, the current price level, as an attractive an attractive entry point for a very strong bank. On the other hand, for the defensive investors, we have gold ETF at the Nairobi Securities Exchange. So basically, this is a security that usually closely tracks the global price of gold. And for those guys who see a lot of uncertainty in the future, they could look at this security for the defensive, as part of a defensive portfolio, and to hedge against the risks that may be there. So we've looked at the recent price trading ranges. on the global gold prices. I think the highest we've seen was in August, about 2070. But then again, there was a lot of profit taking at those levels, and it came down to about 1900 USD per ounce. So there's been a lot of strength at that price level, and given that there's still a lot of macro risks, and also given that countries, especially the world powers, are printing a lot of fiat currency. Fiat currency is basically the normal currency. There's a lot of printing of the fiat currency. Then it gives some strength to gold as one of the best one of the best assets to hedge your portfolio as a defensive strategy. So investor can look at that, over the long term, and also in the medium term, given that there's still a lot of countries are still considering another round of stimulus packages, basically just printing currency. And this is definitely expected to support gold and weaken the normal currencies. So our corporate calendar, Kengen. So this is basically the final dividend of 0.25, and the book's closure is on 22nd of October. So investors should take note of that. So from the macro side, so last week we released our 4Q outlook on both the fixed income and the economic side of our economy and what we expect. So our estimates are basically GDP growth of about 1% for the entire year. And this is much is more bearish compared to what authorities have estimated our economy to grow at. I think the national treasury is about above 2%, and this tends to be reviewed every other time, depending on how the current pandemic is unraveling. So the other point we noted is there's going to be a slowdown in the foreign direct investments. I think the United Nations Conference on Trade and Development has already looked at the data, and they're estimating about 25 and 40% decline in FDIs across African countries this year. So on the MPC side, we expect that the base rate will be maintained at about 7%. I think the current economic fundamentals as stable inflation is still expected to be stable, and thus we expect MPC to remain neutral across this year. So given this outlook and given the risks that are there and the economy that are still being imposed by the pandemic, we still see investors favor short-term maturities on the fixed income end. So fixed income markets last week, activity was basically unchanged, minus 0.4% week on week at 16.1 billion. And trading was mostly on the infrastructure bonds, basically the most liquid bonds you could have. So it is more of a mirror of what you observed over the previous week in terms of trading the secondary market. For the trade of the trading ideas from the fixed income side. Now, last week we went into the detail about the primary bond issues, basically reopenings. And Churchill talked a lot about the dirty price, the clean price, and now that it has been issued, we are recommending investors to bid in at for the FXD1 2011-20. We are recommending investor to bid in at 11.85 and 11.9, basically where the current the implied yield is currently at. And then for the 25-year paper, we recommending investors to bid at the 1330, 1340 levels, closer to where the implied yields are at. So that is basically the quick review of markets and what we are recommending for investors. I think we can look at the Q&A session. Daniel could take over from there.
Thank you very much. We've seen a couple of our members have raised their hands. I believe there are questions. If you have questions, you can share them through our chat or the Q&A section down below. We have Lydia Awor. I have unmuted you. You can please ask your question. Lydia? Okay, while we are waiting on Lydia, we have Geoffrey Gangla. Geoffrey, you can ask your question. We have allowed you to talk.
Morning, and just to thank everyone who's joined the webinar. My question for Gerald is really just a bit more color why we think the real GDP growth will be significantly lower than what government through Treasury is putting forward as their view. Thank you.
Over to you, Gerald.
Thank you, Jeff. I think from what we are looking at in terms of the macro factors, the key macro factors, we are still looking at a situation where there's a lot of fluidity in the current environment. I think recently we are seeing some new data about the new infection rates. I think now we are above 7%. I think I've seen as high as 10%. So there's that increased risk of additional continuing measures that are expected to definitely impact the economy, as we saw during the second quarter of the year. So there's still that factor about new additional continuing measures. And then when you look at where we are at, we are still not yet recovered from where we were in second quarter of the year. So the effects are still there, and then we still have additional effects that could come in if the infection rates are expected to go high. So those are some of the key issues we are looking at. And then when you look at again, when you look at other authorities out there, for example, the IMF and the World Bank, they're still quite bearish compared to what the government is estimating. Government will always give some good numbers because it is positive for them. So during this quarter, we're still looking at those key issues, key emerging issues in terms of how the country is going towards, and is something that, given the fluidity of the situation, is something that can always be reviewed. Thank you.
Thank you very much, Gerald. You've also answered Julius Rando's question, who had asked for you to share your assumptions and reasons behind the 1% GDP estimate for Q4. Wallace Mburu, you can now ask your question.
Yeah, morning.
Morning.
Yeah, my question is on I&M bank shares. At the current price, what can you say about them? Is it a good buy, sell, or what can you say?
Gerald,
thank you for your question. So because I&M is not one of the banks that we usually keenly look at, I would talk generally across the sector, especially for the 5 key banks that we follow, because the sector generally is quite discounted, and this is rightly so, given that the performance of the banks are expected to to be hit very hard this year. I think when you look at half-year performance, there's a lot of increase in provisioning levels across the sector, and ROEs, came down substantially from where the historical averages has been. So for the five large banks, that tend to be outperformance in terms of earnings growth and ROE, we are still seeing some depressed levels of pricing this year, unless this, of course, a very good, driver, or a very good story around the resolution of the pandemic, and then you'll see that those key banks will be the ones that will be the outperformance in terms of a rallying price. But for the other banks whose ROEs tend to be a little bit behind the large banks, they'll take a bit of some time in terms of recovery of their price. So despite almost all the banks being discounted and being at very good price levels, depending on how the situation is going to be, then the different banks will rally differently, depending on the expectations in terms of recovery of their earnings and also the performance henceforth. So I would encourage the investor to look at the key banks, the key big five banks, because those tends to have a much higher return for investors compared to basically the other banks. So basically these are the tier one banks compared to the tier two banks. Tier two banks are banks like I&M. I think we have HF and HF and the like, and then we have the tier one banks like Equity, Corp, KCB. So those tends to have a very good return when there's an upside generally on the economy or the market. Thank you.
Thank you very much, Gerald. Douglas Korir also has a question. I'll allow him to talk. Please, Douglas. Douglas Korir. Okay, well, you can also send in your questions, and we'd like maybe to share more about a copy of the presentation of today's presentation will be available on our YouTube page. That is this whole session, and also you can also start actioning on the recommendations that are shared by our team for this week and previous weeks. That is through our application called Jikuze, where you can buy and sell shares. Douglas? Okay, Gerald, maybe do you have anything to say as closing remarks?
Yes, I would say that from an African perspective, given the numbers that I've just shared in terms of where we are trading at, I think the market still favors long-term investors. When you look at the PE and the div yield, something that is usually considered by foreign investors when they are looking at investing in frontier and emerging markets, it's at a very attractive levels, and I think that investors from starting locally, they should start looking at some of the key counters. I think almost all the counters that have very good fundamentals are trading at good multiples and good price levels. So for long-term investors, is definitely going to there's definitely a very good opportunity. And then when the foreign investors now come in and start looking at our market, then there's going to be a very huge upside, because they are the guys who usually control our market. So currently they are worried about the macros across most of the African countries, and this is definitely a key point for them. But given that macros are not expected to be weak continuously, then the opportunity is now, and then this will be boosted by the activity when they start looking favorable at our markets again. Thank you, Daddy.
Thank you very much for that recap. And I think now we've come to the end of the session. Let us action what we've learned today through this week and see you next week. Thank you very much. Oh, there's a question here. Sorry. Margaret Kimani is asking, can Genghis consider doing a basic sectorial macro-micro economic overview for us as investors? We know some sectors are obviously doing better than others. Gerald, over to you.
Thank you, Margaret. Very good question. I think it's something that we can incorporate in our subsequent reports. But I also hope that you've had a chance to look at our macro report. We released it on Friday last week, and it was going into the detail about our expectations of the different sectors and their performance during this year. So on the micro end, I think it's something we can look at, but on the macro end, I think we have done a lot in that on that side. Thank you.
Okay, so thank you very much, Gerald. And Margaret, we will be able to add you to the email mailing list so that you can be able to receive these reports as they come. Milka, we usually send these reports from time to time. That is, the research department sends them. So all you need to, maybe if you are interested, you can chat us, or you can send us an email on info@genghis-capital.com so that you can add you to the email mailing list so that you can be able to be receiving these reports as they come, as they are released by our research department. Okay, James is asking, why is the price of Kenyan going down and they have not closed for dividend?
Yeah, so good question. I think across the entire market, there's depression in price levels. I wouldn't say it is only Kenyan. I think if you look at the recent 3 weeks, you have seen some marginal movements in terms of the indices themselves and most of the stocks, including the banks. I think the banks, some of the banks that were trading at 38, they have also now come down to about 30, 34. Equities has come to 34. It was trading at 37, 38. So there's that general sentiment in the market that of profit taking during this period. I wouldn't single out Kenyan as the only stock that has been coming down. However, if you look at Kenyan itself as a stock, I think the story is still solid for them. And I think at current price levels, there's a good upside when the market, the general market sentiment turns positive. So you should look at it as an opportunity as opposed to as a risk that the price level is going down. The book's closure for dividend is 22nd this month. So there's still some time for investors who would consider the dividend as good levels. I think the dividend yield is about 7%, which is still solid for a stock. Thank you.
Okay. Jeff has a question again. Jeff, the floor is yours.
Sorry, no, I didn't have another question.
Okay, I'd seen your hand was raised. Okay, thank you.
Okay.
Okay, at this point, I'd like to end the session here. Thank you very much for your questions, and we will see you in the next week. Thank you very much.